Welcome to today's Explainer. We are diving straight into a massive, coordinated shock to the global currency markets. What we're looking at right now is a real-life international financial drama, a literal tug-of-war between organic market forces and coordinated government action. If you've been tracking the currency markets lately, you know something big just went down, and we are going to break down the exact narrative of how and why this all unfolded.
Here is how we're going to tackle this today. First, a historic market move. Second, the actual mechanics of the intervention. Third, the underlying macro pressures. And finally, the market impact and outlook.
All right, part one, a historic market move. Let's start with a number, 15. That is how long it's been since we last saw a joint currency intervention quite like this, a decade and a half. So right off the bat, this signals a highly unusual level of international coordination. When the US and Japan team up in the foreign exchange markets like this, it's a massive plot twist. It tells us that the situation was deemed so critical, they had to cross lines we haven't seen crossed since past financial crises.
And what exactly was that critical situation? Well, the main catalyst was the Japanese yen plummeting to a near 4-decade low. That kind of free fall creates a massive gravitational pull on global trade, and it essentially forced allied nations to step in urgently to stop the bleeding.
To really grasp the narrative of this rescue mission, we have to look at the messaging. From a purely market signaling perspective, we saw public statements from President Trump emphasizing strong financial ties and a clear willingness to help support the yen. In the financial world, rhetoric from world leaders is a powerful tool used to construct a psychological floor under a currency.
This strategic communication was reportedly masterminded by figures like Scott Bessent, and the goal here is to amplify the intervention's impact by projecting a unified, highly visible front. It's a fascinating psychological aspect of currency management. It's not just about the money being deployed, it's about convincing traders everywhere that betting against the yen means betting against the combined will of Tokyo and Washington.
Moving right along to Section 2, the mechanics of the intervention. Let's see how this actually played out.
The sheer scale of this is just staggering. On Friday alone, approximately $53 billion was deployed in a decisive, aggressive move to lift the currency. Let that sink in for a second. $53 billion unleashed in a single day to reverse the tide. It's an incredible show of financial firepower, explicitly designed to act as a shockwave to catch short sellers totally off guard.
But the plot thickens when we look at the timeline. The sequence of these actions across multiple days wasn't random at all. In fact, it was fully expected by macro strategists tracking capital flows. We saw the initial efforts on Thursday, followed by that massive joint New York and Japan action on Friday, with market expectations fully set for continued action rolling right into Monday. It's a relentless multi-day drumbeat. But why string it out over these specific consecutive days?
Well, it comes down to a structural constraint called the IMF 3-day accounting rule. It's a strict guideline dictating that any interventions required to maintain Japan's free-floating currency label have to occur within a concentrated 3-day window. So the story here is essentially a race against the clock. They had a very specific, limited window to fire their bazooka without triggering international regulatory headaches.
Which brings us to Section 3, diagnosing the underlying macro pressures. The reality is, the Japanese economy remains structurally vulnerable. Their domestic inflation is largely being driven by external oil prices and lingering fiscal policy concerns rather than organic, robust economic growth. Imagine trying to drive a car where the engine is weak, but a massive tailwind is pushing you forward. That's Japan's inflation. It's imported from the outside, leaving the economy incredibly exposed to sudden shifts in global prices.
So, the core conflict we're looking at is the widening interest rate differential between the US and Japan. This differential is actively working against the yen. Because US rates are so much higher, capital naturally flows out of Japan and into the US seeking better returns. This means the government's entire intervention strategy is merely about slowing the fall, not reversing the trend entirely. They are literally fighting the fundamental gravity of global macroeconomics.
Now you might be wondering, why doesn't Japan just raise its interest rates to match the US and solve the problem organically? Well, it could theoretically hike rates faster to support the yen. That specific medicine would be incredibly toxic for their already fragile domestic economy. Higher borrowing costs could choke off what little organic growth they have. They are trapped in a classic economic dilemma. Choose between a collapsing currency or a choking domestic economy.
Finally, let's get into Section 4, market impact and outlook. This is the so what for your portfolios. Following these coordinated interventions, we did actually see the yen strengthen by about 1% versus the dollar, so it proves the immediate effectiveness of the move. That $53 billion show of force achieved its short-term goal. It gave the yen a much-needed jolt of life and temporarily broke that cycle of relentless selling.
But when we break down the impact on equity sectors, it gets complicated. If government intervention continues to force the dollar-yen lower, resulting in a stronger yen, it actually puts intense pressure on Japanese equities. Specifically, it exposes vulnerabilities in portfolios biased toward financials and exporters. Think about it. For years, Japanese exporters have thrived on a weak currency, making their goods cheaper overseas. If the government artificially strengthens the yen, they're essentially neutralizing the exporter's secret weapon, creating immediate downward pressure on those stocks. Because the fundamental macro backdrop, that massive interest rate differential we talked about, is still fighting aggressively against these government actions, strategists expect this intense market volatility to continue for the foreseeable future. The fundamental disease hasn't been cured. We've just applied a very expensive, highly coordinated bandage.
So as we watch this high-stakes tug-of-war between organic market forces and government action play out, the ultimate question we have to continuously ask ourselves is, where do we go from here? Will fundamentals eventually overwhelm the intervention, or will Washington and Tokyo commit even more capital to defend the line? It's a narrative that is still very much being written. Thanks for joining me on this explainer, and we will definitely see how this tug-of-war unfolds.